Good evening, guys. So, we've- this will be our third lecture for this course. We're still on the institutional reference points, and we've gone through the order blocks. We've gone through the voids and the fair value gaps. We also spoke about the gaps in price and the candlestick gaps, the small gap and the big gaps being distinguished by the names void and fair value gaps. And now, what we'll be talking about today will be the highs and lows. The highs and lows, double bottom or double top. This is literally what we call the liquidity in the market. And it is among the three key institutional reference points, as we may have it. So we're just going to dive into this. It's not much. As we move ahead, so move forward, we're going to keep talking about this. All our study will be revolved around the three institutional reference points, which is the order blocks, the voice, the fair value gap, and the old highs and old lows, all liquidity. So here we're going to talk about this, and I'm just going to make a quick sketch of the market. Now, for example, we have a price range moving like this. When we see this price range, we see something like a higher high, a higher low, a lower high, a lower low, another lower high, because it failed to take out this high, lower low, lower high, lower low, lower high, lower low, and then price keeps moving just like that. We can tell that this is clearly in a bearish trend. So when you see this, we know that this is a bearish trend. And all these things here, what all these things signifies, these are all liquidities in the market. These are all liquidities. These are all liquidities. This highs, this highs, this high, this high, this high, this high, this high. These are all liquidities. These are all liquidities in the market. These are all liquidities in the market. So the significance of this liquidity is that it tells us the order flow of the market. It helps us to see the order flow of the market, and it still helps us to see when a structure is being changed, like when we have a breakout structure or when the market is changing direction. So when we see something like this, we see something like this, we know that this is a bearish trend. And in order for the market to go back up, it has to raise out this liquidity. Now, in each of these highs, it's called what we have here are liquidities. We have buy stops here, buy stops. People that wants to be buyers and people who sold from here and their stop losses are above the highs. You sell here, your stop loss will be above the high. You sell here, your stop loss will be above the high. You sell here, your stop loss will be above the high. You sell here, your stop loss will be above the high. So you go on and on and on until you get to a point where the market stops going down and eventually you start seeing this price started targeting the highs, and then the price action changes. So yes, that is what liquidity is all about. And now the significance of the liquidity is that when you see a price, for example, you see a price action and they see something like this going down, going down, going down. Now you can say, okay, what is this? What's this? This is clearly a bearish trend. And in order for you to continue the bearish trend, you cannot just go into the market and say, okay, the price is going down. Okay, then you take a sell from here and price does this, goes up and takes you out. No, rather you wait for a significant liquidity to be rated. Because every significant liquidity, as an institutional reference point, just like the other blocks and the void, what they serve as a magnet to the market. They serve as a magnet to the market. That means they draw price to themselves. They draw price to themselves, just like the tap paint roller example I gave here. You have your paint roller and you go up and down, up and down, up and down. Just like what we have here, we have this up, down, up, down, up, down, up, down. So when you see a price price range like this, moving down like this. We anticipate the buy stops to be rated, which means we can see something like this. Price raise this and continues down. You can see something like this. What was that? No, that. I'm so sorry about that. So I'm just going to clean this. Just going to clean this very fast, real quick. So we continue. Or rather, I'll just move this over to this point. So we have this price moving like this, moving like this, moving like this. And inside here, we can have little highs also like this. So you see little highs. So in order for price to keep moving, price needs something to help itself to go down, something like a momentum, something that can push price downwards. And what we need, we can say inside here can be a void, which we've learned. We know what a void is. Inside there can be a void, it can be a fair value gap, it can be anything. But also, as you see a void inside here or a fair value gap, what we can tell is inside here also are these little liquidities, these little highs here. And when you see price raise this little high, together with the other block and the void, which is not our the purpose of today, this is the highs, you see a price move downward. So we anticipate the price move downward when you see the buy stops get rated for a bearish move. And we anticipate the sell stops being rated when, like, for example, these are sell stops, these are sell stops, these are sell stops. Now, if you observe, whenever the sell stops is taken out, for example, here, you see price goes down and goes up back up. Whenever the sell stop over here is taken out again, price goes back up. Whenever here again the sell stop is taken out, price goes back up. So the liquidity serves as a magnet, and once it's been taken out, it serves like a repellent. It pushes price the opposite direction from where it's coming from. So we are going to quickly look at this in the market to see how the liquidity is in the market. It's going to be a quick one actually. I'm not going to take much time here. It's just going to be a quick one. So for this example, we're going to use this pair, USD CHF. Why I choose this pair is because this pair moves literally from liquidity to liquidity. It is always fast moving from one liquidity to liquidity. For example, see what happened, the recent price action over here. This is clearly a high. You see here, first of all, price rated as high. And price rated as high here, I'm making bold so you can see. When price rated is high, price went down. When price went down, you see over here, see more highs, little highs being created over here. These are all highs. See, and price wicks through the highs with this candle here, and price drops. When price drops, you see over here also another high was rated through. So we can actually say every candle high, every candlestick, and when that if it's like, for example, this is a candlestick here, and when this candlestick's high gets rated through, we anticipate that it's going to be a reversal. That means if it gets traded through, we anticipate an opposite direction. Now, this is a bullish candlestick high, and when that bullish candlestick high gets traded through, that means the buy stops resting here, the stop losses of the buyers resting here is going to be rated. And once that happens, we anticipate a sell. That means when the buy stops get rated through, it goes down. Our price went down. Over here again, we see the sell. Over here, we see the buy stops being rated through. And then the sell. And over here, you see price consolidated, like which means moving in sideways. And then you see the highs, they are all rated through. And when they were rated, we saw this price move down, and then suddenly price stopped rating the buy stop, the sell stops. Price started going for the buy stops over here. See here. Now, when you get to this point, you see price tried to rate this. It did not. You can see from here that price did not get to this point, which that means it is not all the time that you anticipate a potential high being rated true. That means not all the time you see high in the market, you anticipate that high to be rated. No, it's not always the case. That means you have to be careful when trading to know which high price is going to come for. Yes, we can know the high that price might come for, or better still, you wait to see if price is going to take a potential high or not before taking a trade. Now, over here, we see price is going bearish again. Over here, this is a whole bearish move. But before the bearish move happened, you see, price tried to take out this high, price did not, and price went down. But also, you see, before price went down, up wait to take this high, price has been targeting the highs. Price took out this one here. This one also was rated. Price went up, price took out this one here with this high, and price took out this one here with this high, and then price went down. When price went down, you see what happened? Price went for the highs. See the candlestick highs. Price went for the highs. Now, plus the high, what else do we see here? Just jog your memory a bit. This is what. You can pause the video. What is this? Well, ready or not, here I come. This is a fair value gap. So price went for the fair value gap, and when price filled the fair value gap, price went down. Again, we have this here, and we have another fair value gap here, and another fair value gap here. You see? Except the high is being rated, except this highs, this high, this high, being rated. Each candlestick highs gets rated through price point for the fair value gap, the fill of the fair value gap. Now, except the fair value gap, what else do we see here? You can pause the video to think. Ready or not? Here I come. So except the fair value gap, we have this here. This is another block. Clearly another block. This is a bearish order block because the bullish candle is being traded through by the bearish candle. That is why it is called the bearish order block. And this is a 1 hour bearish order block. So I'm just going to make that obvious. So you see, and price went for not just the opening of the order block, price went through the opening and the main threshold where the price go for. Price went for, sorry, I'm losing examples off. Price went for the mid threshold of the order block. See, over here. See, and price snapped the main threshold and price went down. Over here again, we see liquidities. These are all liquidities, the highs of this bullish candlesticks. These are all liquidities, and price took out the liquidities over here. Price went down. These are all liquidities here. The same thing happened. So you see, whenever price is going down, price goes for the buy stops above the high, and price sells down. Inversely, when price is going up, we anticipate price taking out the sell stops before price goes up. That means, for example, we're just going to go back a bit. Just going to go back a bit from here. Good. This is a good example. Now we've seen the bearish, how price moves bearishly, going up, going down, picking up the buy stops. Now we want to see the bullish. How does liquidity, the liquidity relationship to bullish order flow. Now you see over here, price took out this liquidity over here. You see the bodies. The bodies are also liquidity, not just the wicks. Not just the wicks. The bodies are also liquidity, because if you do this, you see the body was rated. You see. So this is a liquidity. And when price took this liquidity, price skyrocketed. So we can also use that, because over here we can see that the highs, the lows, we are not taking out. Clearly, we are not taking out. But the bodies, we are taking out. And when the liquidities of the body are taken out, yes, we can also see that as a move upward. And then we saw this big move. Now, what is this? You can pause the video again to remember. I'll give you time. Okay, ready or not, here I come. The reason why I say you should pause the video is for you to understand what you're doing and to help you to know if you are correct or you're wrong. So this big move here is not a fair value gap, it's not another block. This is clearly a void. This is a big void in the market, and this is a bullish void. So if this is a bullish void, what is it going to be called? Remember, I gave you the names of both bearish voice and bullish voice. So if it's a bullish voice, what is it going to be called? Remember, before I write it down, you can pause the video because I'm about writing it down. So this is BC. What is BC? BC is buy side inefficient, buy side imbalance and sell side inefficiency. So this is a BC. We're just going to extend this out in the future and see if possibly price came back there. I don't know. I'm just going to extend it out in the future. Okay. So we saw this. And now you see over here, price is going up, price skyrocketed. Now we don't see really clear liquidities because this is an hour, it's just an hour time frame. We have all time frames here. This is just 1 hour I'm using. And if you go down to the 15 minutes, what you see here, it's a 1 hour consolidation. But when you go to the 15 minutes, you see a whole range and liquidity is being rated. So let's just quickly go down to the 15 minutes and see what we can have here. Let's just use this for that. Let's go to the 15 minutes. Over here, yes, we have a price action. And here you see liquidity is being rated through. This liquidity was rated, this liquidity was rated, this liquidity was rated. But remember, we are bullish. If we are bullish, we don't anticipate the buy sides to be rated. That means we don't anticipate highs to be rated. If we are bullish, we anticipate the lows to be rated. Do not forget that. We anticipate the lows when we are bullish to be rated, not the highs. The lows is also called the set stops. Now, except the lows that was rated, which is all these candle lows here, here, yeah, if you go to the lower time frames, you'll see that each candlesticks here represents let's go to the 1 minute to see if we can see something like that. Each candlestick represents a whole range, and those range have things like structures, and those structures are lows, highs inside each of them. Okay, finding it difficult to find this here. Sorry about that. Okay. Okay, yeah, why this is where we have it. Okay, I'm just going to go to the 5 minutes. Okay, so I cannot go beyond this because this is not a paid trading view. So I'm just going to work with the 15 minutes for now. Pardon me. Okay. So if you have a paid trading view, you can go back and backtest this and confirm. When you go to the 1 minute, what you can see something like this, the 1 minute. And when you see something like this, you see the lows being rated, the lows over here. Because we are bullish, we anticipate the lows to be rated. This low was rated over here. This low was rated. See, sell stops are taken out. Sell stops are taken out over here. Sell stops are taken out. You can observe that as each sell stops is trying to be taken out, you see price trying to go higher. When this was taken out, price trying to go higher, but price came back down and took out the sell stops, all of them, and then price skyrocketed, went higher. See the same thing here. Now, except the lows that was being taken out here, what else can we say supported to take price higher in this whole place? What supported to take price higher except this lows that was being taken out here? This lows, this one, sell this lows, this low, this low, this low, so set them. What other institutional reference points helped price to go higher? Hmm? What other institutional reference points help price to go higher? Well, you should figure that out. You should study and look that out. We'll go high, we'll keep moving. Now, price is bullish. We are looking for sell stops to be rated through. And when you see sell stops being rated, we anticipate a buy. Now, this is what happened here also. See, this is low, this low, this low, and these lows were taken out and price went high. What else did you see? Another block. This is another block. This is a fair value gap that was filled, sniped the other block and price went high. So you can do I can do this all day. You can do this all day seeking out liquidities. The price always go for liquidities. Price always seek liquidity. It's like a force. It drives to it attracts itself to liquidity, and from the liquidity price expands to the opposite direction it's coming from. You see, price was going high and price came back down. Before price came back down, what happened? Took out those buy stops. You can see, took out the buy stops because in why this is a 15 minutes or most of the 15 minutes, you see, why this is a 15 minute and the 1 minute, this is a whole big range. This is a whole range over here. This is a whole range. And when we see this whole range in the 1 minute, we anticipate that this automatically is a high. And when price takes out the high, and this is a bullish high, or rather bullish, yes, when price takes out this high, price comes back down because it has taken out the highs and we're anticipating a bearish move. I don't understand. I don't know if you're following me. Just try to understand what I'm saying over here. Now you see over here also we have the liquidity here. These are all liquidities. Price takes out the liquidity and price goes up. So price moves from liquidity to liquidity. You see over here, when this liquidity also was rated over here, you see the first time it came down, see here, try to come down. What did it come for? This place here. See, there's a gap here, and price tried to fill the gap, and the gap tried to take price higher, but no, what was price going for? Price was going for the low, the sell stops. There are sell stops here, and this is what price was coming for. And price took out the sell stops, it has hit the institutional reference point it was seeking, and price skyrocketed higher. When price skyrocketed higher, you see over here, there's something again here, an institutional reference points that price was trading to. What is that institutional reference point? Here we have another block. Here we have a fair value gap over here. So price filled the fair value gap, but did not snipe the void. The other block, it did not. This is a 15-minute order block. I'm showing the 1 hour. You see that price snipes the order block. So let's just see if we can find that over here. It's not here. It's not here. Not here. Okay. Yes, it's here. So price went high after taking out this low. Now price went for an institutional reference point because price moves from one institutional reference point to another. It doesn't matter if we are bullish. It doesn't matter if we are bearish. What we have to know at the back of our mind is that price moves from one institutional reference point to another. So that is how the price moves from one institutional reference point to another. You might ask, how do you know which institutional reference point and when to anticipate price to go to that point? Or when the price gets to that point, how do you anticipate price to move off of that point? I will teach you that in the coming lessons in the future. For now, let's just focus on the three institutional reference points. Now, today we are talking about the liquidities, and now price is taking out the sell stops here because this is a low, this is a low, the sell side liquidity, sell side liquidity, sell side liquidity. Price is taking out the sell side liquidity, and price has skyrocketed. So we are another institutional reference point. We have the void, a fair value gap here from this place to this place. This place is the fair value gap, and we have this order block. This order block here resting, and price snap the order block, try to come back down. What's pushed price higher? Here again, we have a fair value gap. Observe, the fair value gap was not filled to the 90%. Rather, we have like this is like, let's say 60 to 65, 70% fill. And then the price went higher. When price went higher, again, price took out these highs and tried to come back down. Again, another institutional reference point served as a momentum for price to go higher. And when price did that, price consolidated. And when price consolidated, we are having exchange of orders here because the reason of consolidation is that price is taking orders, taking orders, buy, sell, because inside this little move here, this is 1, 2, 3, 4, 5, 6, 7, 8, 8 hours. This is 8 hours of time because this is a 1 hour candle, and each candle represents an hour. So we have 8 candles, and this is a 8 hour range over here, and this range was taking orders of buy, sell, buy, sell, buy, sell. Now see, price won't, if you were a seller in this place, you would be entering over here when price took out this liquidity, the buy side liquidity. But if you are a buyer, which will be the winning trade, price aimed for the sell side liquidity. So we wait until we see that rate. That you see potential, this is a potential rate of liquidity. You see over here. Price took it out and price went high. So that's how the price moves. See, you might ask, how do we take entries using this liquidity? It's not that easy. Yeah, rather it's not hard. It's not a rocket science for you to think about. Whenever you see a rate of liquidity, you anticipate, okay, according to the pair you are trading. You're trading gold. Gold is really volatile. So if you're trading gold, you should use more stop losses. But for USD CAD, foreign currencies, you should anticipate more than 10 to 15 pips. Over here, we have, this is a 5 pips, 6, approximately 6 pips stop loss. And that's a good trade. You put your stop loss over here, 10 pips, 10 pips from the high, and then you look for the institutional reference point with the 70 pips, and you take your trades. And this is a good trade because this is a 1 to 7 trade. Over here again, you see here it's being rated. You can say, okay, I want to take your trade off of this place. You can put your stop loss. Yeah, see, this is a 25 pips trade. This is not a good trade because it is way much. So when you see price rating a liquidity and it moves above 10, 15 pips, don't take that trade. Why? Because it might not be a rate of liquidity. It might be the price changing its direction. So we take trades that is 15 pips and below for foreign currencies, 15 pips below for your stage now. Take this from the points where the liquidity is being rated. We count 15 pips below, and we can take our trade off of that. Like for example, over here, price rated this, and we can say, okay, this is 4 pips. We can have even much more. Let's go for something like this. Over here, we have here, price took out the low. When price took out this low, we can say, oh, good, this is approximately 10 pips over here. So you can see this is 10 pips. You can take it high, above this high here, and you put your stop loss, and price went down. Remember, what moved price there was not just the liquidity. Price also had things it was going for. Namely, if you look closely, you can see over here we have something. See? See? There was an inefficiency in price action over there, and that inefficiency needs to be efficient. It needs to be filled. So price has to go and fill that place. Now, also, we have something else over there. You can look closely. We have something else. What is that? Another block. Another block. Why? Because this candle was traded through by this candle. This bullish candle was traded through by the bearish candle, traded through by this one, creating a bearish order block. Therefore, we use not just 1, 2, but all the institutional reference points to take a trade. You can either see 1, 2, or 3. So we need to train your eyes to seek the institutional reference point if you want to take a trade at any given point in time. Always remember that when for foreign currencies, when the stop loss is above 15 pips, you should just let the trade be. This is possibly going to be a change of direction of the price, so you should just let it be. So that will be all for today. You guys are not really moving moving with me as I thought we should move. You don't ask questions. I don't know why. So I don't know if you watch the videos or you just go through the classes and you go take trades. I don't know. I understand the other guy, Alan. I understand that you must have known, but you should try to watch the videos and then ask questions. If not to me, you should reach out to your other students who knows better. Okay, so that'll be all for today. See you. I talk to you next time. Good luck.